What's up, YouTube? This is Thomas from Thomas Invest and thank you for watching. Today I want to talk about Stag Industrial, ticker symbol Stag. This is a stock that I own for a long time, and one of the interesting things is that they pay a monthly dividend. In this video I will show you what Stag Industrial does, some interesting facts coming from the 10K file and the investor presentation. In the second part I will talk about the fundamentals and if I'm going to buy Stag right now and some possible alternatives. If you're new to the channel, make sure to subscribe to get notified when I'm posting a video. I also appreciate an early thumbs up, which helps me within the YouTube algorithm. For now, let's dive into it. So let's start with what Stag Industrial does. This is what they say about themselves on their website. Stag Industrial, ticker symbol Stag, is a real estate investment trust focused on the acquisition and operation of single-tenant industrial properties throughout the United States. By targeting this type of property, Stag has developed an investment strategy that helps investors find a powerful balance of income plus growth. They have more than 500 buildings active in 40 states with approximately 103 million rentable square feet according to the website. In the investor presentation, there's a lot of interesting information about the properties they own. But first I want to talk about the focus Stag Industrial has with these properties. In this sheet, we see the growth of e-commerce sales within retail and the decrease of retail inventory to sales ratio. Stag claims 40% of the portfolio handles e-commerce activity, meaning they are trying to focus on the growth of e-commerce sales with the properties they have. Another interesting thing they claim in business is diversification, and I think this is really important for companies like Stag Industrial. Imagine what happens if they were focusing on a specific industry or market, which collapse. Then Stag Industrial is going to feel a lot of pain. But with a diversified portfolio, they will not have this problem at all. Stag Industrial has more than 60 markets within the portfolio and exposure to 45 industries. The largest market is less than 8% of the total amount and the largest tenant is less than 4%. Less than 25% of the leases expire through 2023. Which sounds like a lot, but it's highly likely these leases will continue. In this sheet we see some interesting things about their tenants. We see some big names and we also see that 53% of the tenants is publicly traded. So if you ever worry about the tenants, look up their financials. 84% of the tenants have more than 100 million in revenue. 60% of the tenants have more than 1 billion in revenue. The largest tenant was less than 4% as said before. And in here, we see that Amazon is representing 3.8%. The top 10 tenants together represent almost 12% of the total. So I think they are diversified enough. Now that we know enough about what Stag Industrial does, it's time to dive in some fundamentals of the company. Stag Industrial is a 7.45 billion market cap company and has a PE ratio of 33.8, which sounds high because you want this number to be around 20. But REITs in general have a higher PE ratio, so I'm not that worried about it. Stag Industrial has a profit margin of 37% and an operating margin of 29%, which are both fine to me. This is also one of the things REITs have in common, higher margins than typical companies. In the left chart we see the revenue growth of Stag, which is going upwards, really nice. So this comforts me a lot. On the right we see the net income growth of Stag. Since 2016 it's going up really nice. The return on assets and return on equity are a bit lower though. Stag Industrial has a return on assets of just 2% and a return on equity of 7.5%. On the balance sheet we see that Stag Industrial has a total cash of $44 million and a total debt of $2 billion, which is a lot. But Stag also has a current ratio of 1.88, which comforts me again. You want this number between 1 and 2, so they do a really good job here. The operating cash flow is sitting at $324 million. This cash flow is also used to pay dividends, do acquisitions, buy back shares and for research and development. If we zoom in on the dividends, we see that Stag Industrial has a dividend yield of 3.5%, which is very nice, and an annual payout of $1.46 a share. But we also see that the payout ratio is at 140% right now. Meaning they are not capable of paying out the dividends by themselves. You want this number to be below 85%, so there is a margin of safety before you hit the 100%. The 5-year growth rate is at 0.85%, meaning there is not much growth in the dividends. Another interesting thing is that Stag does pay a monthly dividend. So instead of receiving quarterly dividends, you will receive $0.12 every month for every share you own. But first, let's go back to the payout ratio. In this chart, we see the amount of shares outstanding since 2010. It's increasing every year. This means that the more shares they issue, the more shares outstanding there will be. And for every share they issue, they need to pay extra dividends. So you want this number to be decreasing, so your share becomes more valuable because there are less shares to own. And on the other hand, decreasing shares outstanding means less total amount of dividends that needs to be paid to the shareholders, which could lead to bigger dividend increases. For me, this is a big concern. They need to push down the payout ratio, otherwise they can't hold the dividends at these levels. The next thing I want to explain is the compound effect, or snowball effect. I know the payout ratio isn't at a good level, but let's put that aside and think of it as a healthy dividend stock. I know it isn't right now, but let's pretend. Stag Industrial Stock is at $42 a share. They pay a monthly dividend of $0.12, a quarterly dividend of $0.36, and a yearly dividend of $1.44. This means you will need roughly 29 shares to buy 1 share per year with your dividends, if the stock price stays around $42. To buy 1 share with your dividends every quarter, you will need to have 170 shares, and to buy a share every month with your dividends, you will need 350 shares. It's a nice thing that they pay monthly dividends, but I don't think this should be a reason to buy this stock, if they cannot hold up the dividends with the payout ratio being too high right now. But whenever they are able to bring this payout ratio down, it could be interesting to own this stock, for the compounding effect. Also to use the dividends to buy other stocks. There are a lot of different REITs available in the market, but I want to show you some specific competitor industrial REITs. I won't do a deep dive in the competitor stocks, but I just show you the annual revenue growth, PE ratio and dividends of some competitors. First one is Americold Realty Trust. We see that this company has some decent growth in revenue and have a PE ratio around 22 and an estimate of 26 for 2021 and 2022. Right now, Americold pays a 3% dividend yield with 3-year growth and a somewhat strange payout ratio. Not sure what's going on there. Next up is First Industrial Realty. We see a decent growth in revenue since the financial crisis in 2008. Right now they have a PE ratio sitting at 30 and an estimate of 28 for 2022. They pay a dividend yield of 1.77% right now and an annual payout ratio of 57, which is really nice. They also have a 5-year average growth in dividends of 7% and increased their dividends for 8 years in a row. This looks really good to me. The last competitor we are going to check is Eastgroup Properties. We see that the revenue is going up really steady, so I like this a lot. EGP has a PE ratio around 33 and a 22 estimate of 30. Eastgroup Properties pays almost a 2% dividend yield right now and have a 5-year average growth of 7%. Apparently, there's no payout ratio known at this moment according to Seeking Alpha. My conclusion is that the industry Stag is focusing on is really nice. E-commerce is already booming and it's expecting to grow only more. Those e-commerce companies need big warehouses and Stag has them ready for them. There are some concerns about this company with high amount of debt and the payout ratio being too high. On the other hand, they pay out a nice amount of dividends on a monthly basis, but this is under pressure with the payout ratio, so that's not a buy sign for me. I do own shares of Stag Industrial and I'm happy with it. Also because of my lower entered position. For now I'm holding Stag. First I want to see the payout ratio going down. If the payout ratio doesn't come down, I might think of selling this stock in the future. If they cannot hold up the dividends, of course. But for now I will hold them. Another interesting fact to know is that Stag Industrial is going to announce earnings on the 17th of February. So I'm really looking forward to the earnings because this is a moment that could change a lot for this company. They need to present good results, otherwise this stock will go down, I think. For now, I just hold the stock and wait for the earnings and hopefully the payout ratio to go down. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.